Alaska. So welcome from as far away as Alaska. I'm gonna see if I can share my screen real quick and I'll jump right into this. If everybody will give me a thumbs up that they can see this, that would be helpful. Cool. Let's see why that doesn't want to work. Sorry. There we go. So just very quickly, as a way of introduction, my name is Matt Hottle. I do have a fair amount of investment experience, although my entrepreneurial kind of experience and roots are probably much deeper. You're probably realizing right now this picture was taken pre-COVID hair, as I have now let it grow out quite a bit since then. But there's just a couple of stats there. I won't read through all of them, but probably the most relevant right now is that me and my partner Mickey Millsap are managing a $25 million venture capital seed stage fund here in Alabama. So let me see if I can move these frames around. That's better.
Oh my God.
Are you there? Somebody had something to say.
We are here. If everyone will make sure you're muted during the presentation, that would be helpful. Thank you.
Somebody saw something that they were excited about, so let's hope that was good news. So let's just talk about the basics real quick. Venture-backed companies typically raise multiple rounds of funding. That may be new to some of you, but probably not to a lot of you. Once you raise capital, it becomes a regular part of your operation and growth. I hate to tell you this, but it kind of starts a cycle. We hear this a lot when we have founders that say, well, I was really happy to be done with the seed round because I hate fundraising, and we kind of have to break it to them that, well, you're going to do it again in like 9 months. So don't get too comfortable not fundraising, because it does become one of those things that you will do usually repeatedly, especially at a kind of a fast scale or fast growth company. Ideally, the previous capital plus your organizational growth should make the company more valuable. Sometimes you hear people say, well, it was a down round. Well, what they're really saying is that they got a lower valuation in a subsequent round than what they had in the previous round. It's not the end of the world. Sometimes people make too big of a deal of that, but it is something that you're trying to shoot for, that your company is more valuable with the capital plus your growth and your operational gains, that every time you raise, you'll raise at a little bit higher valuation, sometimes significantly higher valuation. And that's why you want to mark up of each round. So I want to get something right up out of the way. There's a lot of naming nomenclature when it comes to fundraising, and it's largely semantic. You can see guides and you can see different things. You'll see people say that, named rounds or alphabetized rounds. So A round, B round, C round, whatever. That's when you're really doing, it's equity only. It can't be convertible notes. It can't be safe, instruments. It has to be an equity round. It has to be with shareholders and a board and all that stuff. And there's actually nothing legally saying that has to be true. I will say that this is as much for the lawyers as it is for anybody else, because they're just used to these terms. And you'll see a lot of different terms around all of this stuff. So you'll see friends and family round, right? Angel, pre-seed, seed, post-seed, A through H rounds. Or I think in the case of Uber, I think they got to like K or M round before they finally went public. But those are all just rounds to signify it's one round or subsequent to the previous one. Why it's that way, I don't have a good answer, just kind of the way it is. But I put in a quote from Kathy Nolan, and just to kind of highlight this, like she says, you could call it series butterfly. It doesn't really matter. It's really for the lawyers more than anything else. But just so everybody's clear of that, because we get a lot of questions like, well, is this a seed round, a pre-seed round, an A round? To be honest with you, early stage investors, doesn't really matter what you call it whatever you want. But just to give you an idea of how to kind of align the thought of where the company is versus the financing type, typically you'll see at the concept stage or cocktail napkin stage or lean business canvas stage or whatever you want to call it, that typically is your friends and family kind of round. That's like people or mentors you've had or whatever the case may be. Sometimes you can get an angel investor, and an angel in the context of this conversation is high net worth individual, somebody that probably has some entrepreneurial startup experience. They may get involved at the concept stage. They may want to be involved at the MVP stage, meaning that I've taken the concept, I've gotten my basic code, I have something that's sellable and kind of a minimally viable product, but now I'm out of money and I need financing. Pre-seed, which is where I would argue the Alabama Futures Fund stays, is pre-seed and seed, which is kind of post MVP and go to market. So I have my MVP, I have some early traction, I've tested a bunch, I have some, interesting, data to share that shows there's something here. Now I need some financing to go to market. That's typically your pre-seed. Seed, I put at 500K plus in annual, run rate. I'm calling it run rate, not recurring revenue. It's too early to know if it's going to be recurring. Post seed, $1 million in run rate. A through H rounds, you just consider those growth. So pretty much over $1 million. Understand this is arbitrary, and it's likely you'll see fluctuation throughout these different kind of buckets as we go forward. We definitely started to see an erosion of some of this conventional wisdom over the last year, and probably even more specifically over the last 12 months. You see people who typically don't go earlier or going earlier. Some people are withholding cash and going later. It's just all over the map. And I think COVID had something to do with that, but deal flow is a little more fluid than it used to be as far as how it slots.
Matt, can I jump in with a question we have in the chat?
Sure. Yeah.
May get to this, but thinking of pitch competitions or other ways you might earn some non-dilutive funding, how would you characterize that in like talking about your rounds, maybe specifically in your executive summary or other materials where you're sharing about what you've raised to date?
Yeah, that's great. So two things, right? So you may do a competition that is non-dilutive, and I would argue you can do that kind of in any one of those early stages, right? Friends and family, angel, pre-seed, go for it. My business partner, Mickey, tells a story about they largely launched UShip in Austin out of basically running a competition circuit for like 9 months and trying to win as much non-dilutive capital as they can. It's always good. If it comes with some sort of equity or conversion to equity, you have to be very careful about where you're doing that, under what terms, because if you already have investors and they already have terms on a current investment vehicle, whether it's a convertible note, whatever, that can be problematic because you may or may not be giving them most favored nation status, and that probably runs afoul of your agreement with them. So you do need to be conscious about that. As far as talking about in your executive summary, I would put it on like you would anything else, which is, this is something that we did. This is a competition we won. This is a competition that we even just competed in. I like seeing those things, especially from programs that we know and we have a relationship with. If they're of high quality, you probably got great feedback, if nothing else, even if you didn't win any money. So all of those things I think are worth including. I do think it's important that your stage and fundraising goals match potential investors. And the easiest way to do that is just do your research, right? Crunchbase, you can get a lot of information for free on Crunchbase. Obviously, Google, try to find out as much as you can about the investors. You can borrow, I use them quotation marks, PitchBook access. Do not go and buy PitchBook access for yourself. It's very, very expensive. And the fact of the matter is there are a lot of organizations, support organizations, and Generator may even have access itself, but there are ways to get access to PitchBook information, and PitchBook information really is kind of the gold standard. As far as that goes, you can do lists of geography, by stage type, by name, by whatever you want to do. And that is important. So think about those things. Where are they located? May matter, may not matter. Some people are really geographically based, right? They only invest in things that are around them. Where have they invested geographically before? Because you may find that's like Steve Case at Rise of the Rest. He doesn't do coastal stuff, right? So he loves, and Revolution loves stuff in the middle of the country. Obviously, Generator, being based out of the Midwest or largely based out of the Midwest, has a great network of non-coastal investors for any of you that are non-coastal, right? Or in less traditional startup hubs like we are here in Birmingham, as an example. So all of that stuff can be found and utilized. Alignment there will save you a ton of time because otherwise you're wasting your time, you're wasting their time, and it's not going to go anywhere. It's not like the movies. Nobody's going to see something like sitting on the edge of a desk somewhere in a big name, growth fund and want to all of a sudden decide to go into your angel round. Just doesn't work that way. And the other thing too, and I think this is one that's overlooked a lot of times, reach out to founders that raised at your stage. Who did they raise from? Who did they work with? Who would they recommend? Who would they tell you to stay away from? Believe it or not, I know this is going to be shocking. Not all investors are great to deal with. Not all investors are great to have on your cap table, and they have a reputation, and those reputations are largely formed through their work with other founders. So founders are really pretty honest and open and candid about that stuff. And if they've had an issue, they'll tell you. And if they've had a great experience, they'll definitely tell you that as well. So let's start by setting your fundraising goals. I had this experience last week, as recently as last week, which I asked somebody, I said, well, what are your goals? Are you going to fundraise, or are you good for now, or whatever? And they basically, their answer was, oh, we're going to fundraise. And I said, okay, well, what are you looking for? And he's like, well, I'm open to offers. That's not a way to run a fundraise. Investors are not going to float an offer to you. It's just not how they think. It's not how they work. They want to know what you're seeking and why you're seeking that. So start by setting your goal. How much do you need to grow over the next 12 months? Why is it 12 months? Two reasons. One is you got to pick a timeline anyway. Might as well pick the timeline of 12 months. In my experience, at seed stage or early stage, you will spend approximately everything you raised within 12 months, even if you think your runway is 18 months. I don't know why that is. It just happens. So start at 12 months, and then understanding that you want to raise 3x, 4x, 5x, 6x, whatever you decide it is at your next round, then work backwards. And I'll show you a chart, and this is a generator chart, and I think it's a really good one. But working backwards from 12 months and your next fundraise, figure out what that needs to look like and the milestones you need to hit there. And I'll walk you through that chart in a second. And then minimum check size. This is, again, something else that you have to think about, especially if you're doing early stage. Minimum check size means the smallest check you will take in your round. If you're raising $100,000 and you're willing to take $1,000 checks, that means you can have 100 people on your cap table by the time you've raised $100,000. That's problematic. And it's problematic for a number of reasons, not the least of which is that's a lot to manage for $100,000. You might have somewhere between $500 and $700 a year in just opportunity cost and information rights servicing. What do I mean by information rights? If somebody's invested in your company, whether it's a convertible note, it's a safe note, it's equity, whatever the case may be, there are certain things that you're going to be expected to provide to them, like quarterly updates or biannual updates, or even just returning phone calls and emails. That stuff costs you time, and that costs you opportunity as well. And so if you think about taking really, really small checks over the next 5 to 7 years, which is about how long you carry anybody, no matter their check size, on your cap table, that can add up to a lot of cost for very little actual liquid value in the capital. So keep that in mind when you do it. At the same time, if you say, I'm $100,000 and I'm only taking $50,000 checks, you can do that, but understand the population of people that can write you $50,000 checks is also significantly limited compared to, let's say, $25,000 checks. Next thing you want to think about is your vehicle. And I know that Generator and programming will go through these in detail at some point, so I won't go into a lot, but just understand what vehicle you're doing. Are you doing a safe note, or are you doing a convertible note, or are you doing an equity raise? And I break out safe notes and convertible notes. Even though they operate largely the same way, they are viewed very differently by investors. Some investors, ourselves included, we really don't do safe notes for initial investments. We might do a safe note for a bridge round. We might do it for some additional financing, but we're probably not going to do it for our initial. And there's some reasons why that is. I won't go into those details, but basically we just don't prefer them as a vehicle. Convertible note, on the other hand, which basically functions very similar to that, we do all the time. And we use those as our preferred method of our initial investment. Of course, you could do an equity raise as well, which is a very simple transaction. You're going to sell X percent of the company or the valuation of the company for Y amount of money. And then your term salt. And this is where, if you don't have this, this is where these conversations can get difficult or won't move forward because an investor is waiting for you to tell them what you're looking for. Maturity dates, how long does a convertible note have before it converts or before it becomes due? The interest rates, Simple interest rates usually between 5 and 7%, 4 and 7%. It really doesn't matter. It's not a huge number. And then the valuation cap, if applicable, depending on the vehicle you have. Those are going to be the three things you want to set. And there's a whole strategy in thinking about how you want to do that. I won't go into that in detail right now, but I'll give you some general guidelines in a future slide. So this idea of working backwards, let's start with this. So this idea of if you are looking at 12 months ahead and saying, I'm going to run out of cash at X date. And then you back up and you say, okay, I need to start raising money way before that. And this one says 6 months, 4 months. It's kind of arbitrary, but it has to do with, are your existing investors likely to participate in a future round? That's one thing. That might shorten the amount of time you have to fundraise. How much are you going to fundraise? Is it a challenging fundraise? Meaning like I may or may not have met as many of the goals that I wanted to meet. That's going to be more challenging. It may take you more time, so you have to budget that time. 6 months, very safe bet. 4 months is what we see a lot, but somewhere in that time frame. But between that time when you need to start raising money, you then go back and say, okay, well, what milestones do I have to hit so that I can hit that 3x, 4x, 5x, whatever I've determined is my goal in my next valuation. So I've raised money. Now I'm going to go out and raise money again. I want to hit a 3x valuation. What are the things that I have to do working backwards to get to the point where when I go out and fundraise 6 months, 5 months, 4 months before I need the cash, I have a compelling story to tell them. I'm saying the things that they want to hear, and they're seeing progress from, where we started with the last round of financing. Valuation. This is always the, multi-million-dollar question, but there's just, there's so many opinions and so many viewpoints about it. And you can read the headlines and go, okay, well, somebody just got $10 million on a pre-seed company that hasn't written, a line of code, and go, oh, well, that's interesting. It is interesting. It also is not something I would use as some sort of mark to market. Those are still very rare. And yes, they are as ridiculous to investors that didn't do the deal as they seem to you guys when you read the headlines. But let me just give you some general thoughts on this stuff. So first, early rounds are the most expensive for growing companies. If you are growing, typically speaking, your first couple of rounds are going to be the most expensive from a dilution standpoint. That's normal. It also usually makes first-time fundraisers nervous. Don't let it make you nervous. It's normal. The valuations will vary by region or investor. So you may get really high valuations on the coast. You may get much lower valuations in the middle of the country. That's based on two things that have nothing to do with each other. One is valuations can stay high in competitive rounds, or they can stay high when somebody has to deploy a lot more capital into a company early than what they would typically do. And the reason they want to raise the valuation is to then justify why they're putting more money into that company earlier than they would normally do it. Has nothing to do with the founder, has nothing to do with the market. It's kind of crazy to think that happens, but that's some of the economic math that it works out for investors. And the other part of it too, for valuations can be just based on that competition, right? They have somebody who offered them this valuation, somebody else is going to hire even higher valuation, and it becomes this horse race. It's not something you typically see in the Southeast, for example, where we are, but it does happen. And the other part of it too, and this is really important, and I'm sure you guys have talked about it. If you haven't, you will at some point in some detail, is high valuations for early stage companies aren't always good. If you think about the fact that I need to be 3x, let's just use a 3x because it's easy math. I want to be 3x bigger each time I raise. If I go out and I raise $1 million in my pre-seed, right? That means, let's just say for giggles, that's a $5 million valuation cap, okay? So when that converts at some point in time in the future, that will either go at a 20% discount on a note, I'm just using that general term, 20%, or it's going to convert at the value cap, whichever is better for the investor. And you see those in most convertible notes. So if that's a presumed valuation, for lack of a better term, for a growing company at 5 million, then the next time you raise, you want to raise at 15 million, right? You don't want to raise at 10, you don't want to raise at 8, you want to raise at 15. That's probably pretty reasonable, right? Because now what you're talking about is you're talking about going from, let's say $100,000 in total revenue or $150,000 in total revenue to about 1.25, 1.5, right? Now at that point in time, you're going, okay, at $1.5 million in run rate, not even recognized capital yet, but just run rate or realized capital, I should say, that's still doable. Now, let's flip that and say you raised $5 million at your pre-seed round. And you did it on a $25 million pre-money valuation or valuation cap, sorry. Now you have to be a $75 million company. So you have to go from a couple $100,000 to, let's call it $7.25 to $8 million in run rate in the same period of time to have the same amount of factoring up, so 3x. So sometimes if you think about it that way, that's really hard to do. And likely that's not really where you see the explosive growth of a startup. You actually see the explosive growth of a startup usually post A round, right? So post first equity round. A lot of times it's the first time you get institutional money. A lot of times it's the first time you get really strategic investors who know that space well, can introduce you to potential clients, has a great Rolodex of future hires for you, et cetera, et cetera. And that's really when you see a company will take off, not at a pre-seed or a seed round, but at an A round. We've seen it in our own portfolio, that to be the case. So that's why sometimes you want to just be clear on high valuations. Just because someone will give it to you doesn't mean you should take it.
Matt, can I jump in with another
Please.
question? Thanks for talking through that example. I think it's really helpful to understand how you can really increase that in valuation later on and kind of make up some of the ground
Sure.
later. But a question about equity. So what do you see in terms of if there's a normal or range of amount of equity a founder would keep, maybe in examples at the pre-seed or seed stage, and how that might come to pass over time by the time of an exit?
Yeah, I mean, I would say, and this is tough, it really does vary from place to place. Y Combinator came out a few years ago and says between your early rounds, your seed rounds, and your A round, you should expect to give up somewhere around 30 to 35% of your equity. The first 3 rounds are usually about flat. So you can think about it as like an easier math, 12, 12, and 12, right? So 12% for your pre-seed, 12% for your seed, and then another 12% for your A round. But this is also too where you start to see that trail off. You're no longer going to be giving chunks that big anymore. Subsequent rounds will probably be for less than that. And it won't be dramatically less. I mean, it might be 10% in your B round. It might be another, 8% or 7% in a C round or whatever. But by that point, we're talking about massive amounts of money if you're getting that far along and you're raising those kinds of, and especially if you're even keeping to a 3x every time you're round. But more than likely, some of those rounds will jump 5x, 6x, 10x from your last round. So that's how that usually works out. But again, everything's different. Everybody's unique. Everything is different. There are certainly companies out there, and we have portfolio companies that have given up more than that by their A round, and they're doing fine because it's still a really valuable company. And again, it's the old saying, do you want, an entire, I use the pizza analogy. Do you want to own an entire extra large pizza, or would you like to have 20% of a Pizza Hut franchise, right? Or in this case, Domino's is doing better than Pizza Hut. So Domino's franchise, which would you rather have? 100% of a little tiny thing or 20% of a really big thing?
And I'll recommend anyone to go back to the VC math presentation we did at kickoff, and I can share that with you, Dee, that kind of talks about if you get down to 12 or 13%, something remaining, what that actually comes out to if you've been a successful founder. And also what, I shouldn't use the word successful, if you've had an exit that's, going along these lines of 3 to 5xing, 3 to 5 times your valuation raising each time, but also kind of how the math works out for the VCs and kind of their portion, and where the founder, even at that, relatively small percentage, you may think still comes out on top usually. So I'll share that as well. Thanks, Matt. I'll get back into these questions as we go.
Yep, great. So let's talk a little bit about how you talk about your fundraise. And this is you can use an executive summary, your pitch deck, whatever you want to use, whatever vehicle you're using. A couple of things just to think about. And this is not a comprehensive list, but just I think some of the more important ones, which is, and we miss this in pitches all the time. Start with why you were raising and what you were raising. So let's just get that out on the table. If you're pitching that the raise will cover more than 12 months, I would reconsider your backward math. Most investors tend to believe that if you say, well, I'm raising $1 million and that should make me good for 24 months. I'm going to tell you, don't do that for two reasons. One is you're either raising twice as much money as you should, and it's really expensive right now. Again, the early rounds are the most expensive rounds. So why raise, twice as much as you need for twice as much dilution as you're going to establish in that. The other part of it too is I'm going to say, well, you're moving too slowly, right? If that's going to get you to 24 months, I'm going to tell you, you're not spending money fast enough, you're not growing fast enough, you're not being audacious enough. And for a venture capitalist, that's going to signal this is a lifestyle company, this is a slow growth company, this is a company that eventually in 3 years will be a $10 million company. I'm not betting on $10 million companies, I'm betting on $100 million company, $1 billion companies, whatever the case may be. How the capital will be used with some detail. So slapping percentages to major activities isn't super helpful. We see that in slide decks and executive summaries all the time. But the reality is that if you just say 30% to marketing, well, I don't know what that means. So is marketing, I'm going to hire my kid brother to build a website and then run a bunch of social media posts, or is 30% being used in this kind of A/B testing in these environments based on what we've learned from these 4 things? Just be prepared to talk about that in some detail. It shows that you have, some amount of sophistication around your capital allocation and how you're going to use it. It's fine to have that slide, but in your appendix or somewhere buried below that, really have a breakdown, because you'll be surprised how often an investor goes, great, I see that 30% of this is going to marketing, but I don't know what that means. Also, to think about capital in kind of 2 different ways. Is it oxygen or is it gasoline? Oxygen is what I said when you said, I'm going to do, I'm raising $500,000 and that should get me for 2 years. That sounds like oxygen, right? That doesn't sound like gasoline. That sounds like the $500,000 is going to keep me alive for 2 years. Well, that's not what we're trying to invest in. What I'd rather hear is the $500,000 is going to be gasoline. It's going to accelerate me from this point to the point I need to be in 12 months. And then I'm going to go get more gasoline, right? But I'm not thinking about this capital as what's keeping me alive. I'm thinking about this capital, what's going to grow. That's what your investors are interested in. They are not interested in de-risking your lifestyle, right? Replacing income, making sure that you can live in the places you want to live. I got to be honest with you, we all care about that stuff for you as founders, but it's not in the investment thesis, just to be honest. So think about it in the terms of, am I explaining this? Am I thinking about this like oxygen, or am I thinking about this and explaining this like gasoline? How does the round fit with previous rounds? Why are you raising this round now? What did you raise before? Why is now and this type of raise at this valuation, at this amount of money? Why does this make sense? And how is this value add? One of the things I always say is people often make the mistake of saying, we messed up this, that, or the other thing in our last round. We raised too much, or we raised too little, or during halfway through, our pricing model was completely wrong and we had to change it. This is how we changed it. This is what we learned. This is how we're going to apply it in the future. And this is why we think this will work. Investors in subsequent rounds love hearing that. And there's a central reason why. 2 reasons, actually. One is shows the ability to learn and adapt, right? Which is an incredibly important function as a founder. And the other 2 is, frankly speaking, you made that mistake on somebody else's dime, not mine, which is great because now I don't have to pay for that mistake. Somebody else already paid for it. So my money can go towards something that's more proven, something that actually does look more like gasoline and not oxygen. So something to think about. Include the terms that you're seeking, right? Don't go, 4 conversations in and then say, I have to have a safe note, and they go, we don't do safe notes, because then you just wasted everybody's time. And this last one is, I think, a stylistic one, but I also think it's a mindset. Be audacious while being honest. I do see too much conservatism in some of these pitch decks. I use the example, we invested in a company called Link, and everybody from the outside looked at it and goes, well, they're just digital business cards. Like that's not venture backed. That's not scalable. That's not that interesting. And if that's what we thought they were ultimately going to be, I would agree with you. That being said, they literally sat down and kind of with all the audacity in the world said, we're going to replace LinkedIn. And here's how we're going to do it. And it was the most ridiculous statement. And I knew it wasn't true. And that didn't matter to me, because what it said was, these are my goals. This is how big I'm thinking. And that to me as an investor was really appealing. So then when they broke down what they were going to actually do, it sounded like, hey, these guys have got some big goals and I'm pretty excited about it. But they were honest about it. They said it's going to be hard, and this is why it's going to be hard, and this is how we're going to deal with that. So being able to balance those two things are important. If you don't take credit for your big ideas, if you don't take credit for how passionate you are about something or what you really believe you're capable of, it comes off as being something that looks conservative, and it sounds more like you're trying to get a bank loan than it is that you're trying to get, investment from an institutional investor. So this is the slide I love, and I love this because this is the stuff people don't tell you. So investors don't always act rationally. You could have the right pitch to the right group at the right time with the right valuation, with the best deck and everything, and they still pass. Or they ask you ridiculous questions. We had one that we recently invested in. It's a female founder, and she literally sat down with a very well-known institutional investor, thankfully not in Birmingham, somewhere up in the Northeast. And they basically told her, hey, if you will make your male co-founder the CEO, will invest, but we're not going to invest with you as the CEO. Straight in the eye, looked her straight in the eye and told her this. I mean, this is a woman who went to the London School of Economics and the Warwick Business School. She's an attorney. She's incredibly well respected in her field. She is unbelievably capable as the CEO, and she still had that. Totally irrational, totally ridiculous. It still happens. That's just the reality, and it's something that we have to understand, not accept, but understand. Many investors are lazy. Every investor out there is going to hate that I said that, but it's true. Most early stage investors, especially in pre-seed and seed, the statistic was, as of, I guess, 18 months, last time I saw it, was that 10% or less of pre-seed investors lead rounds, which means that they're not the ones initiating the investment. They're simply following on. So they're waiting for their buddies to bring them something. They're syndicating in all their deals, which means that they're not leading it. They're just following on with other lead investors. They're looking for pattern matches, right? Things like, I've seen this before in this other environment. And that leads to all sorts of problems, not just from a investment thesis problem, but also from a diversity and inclusion problem, right? If you don't look like other founders, if you don't sound like other founders, if you didn't go to the same school as other founders who have been successful, that's all a version of pattern matching. And frankly speaking, it's really destructive. And it leads to a lot of the reasons why we don't have diversity, not just ethnically, gender-based or anything, but also geographically based, right? If they haven't seen a bunch of high growth startups come out of Dubuque, then they go, well, why would I invest there? It's silly. It doesn't make a ton of sense, but it does speak to how there is a kind of a general malaise or laziness around it, because there is a ton of high inbound deal flow. These guys are getting inundated. These guys and gals are getting inundated every single day, 50, 60, 70. The bigger firms are getting 100 decks a day. And they have junior associates that are combing through it, and they are pattern matching. They're looking, where did the founders go to school? Do they have a previous experience there? Where are they located? What's the total market size? I mean, it's like a checkbox. They might as well be working at the IRS, because they're just going through and looking for stuff that matches their list. Startups with vanity valuations or raise amounts rarely get investment. That's just a harsh reality. If you go out there and you say, I'm raising $1 million, and when somebody asks you, why are you raising $1 million? And basically the answer is because it sounds good. That's a terrible rationalization, and you want to avoid that, because now it sounds like it's a vanity metric. I just want to say that I raised $1 million, when in actual fact, 750 would have been fine. Or the reverse, I really need 1.2, but that just, for whatever reason, doesn't fit the internal narrative. Also, too, the valuations. I get everybody wants their company to be worth $10 million, but when we see somebody come across and they say, my pre-revenue company at seed stage needs a val cap of $10 million, we're not doing that deal, right? It's outsized motivations on the side of the startup and not on the investor side. The early money is the riskiest money. You have the highest rate of failure at early money, so there has to be a reward for taking those risks. And the 20 or so investments that we'll do in our 5-year active period of our fund, we expect 16 of them either to return no funding or go to absolute zero write-off. Think about that. That's the reality of what we're dealing with. We're dealing with 80% failure rate of the companies we're investing in. Story matters, right? You can have all the mechanics, you can have all the financials, you can have all that stuff, but if your story of why you're doing this and why this is important and how you're going to do it, if you're not telling that story well, if your pitch deck is not great, or it's less than, your best effort, or poorly researched, or sent to the wrong people, has typos in it, that kind of stuff, believe it or not, it matters. Should it matter? Maybe, maybe not, but it does. Like I said before, it's better to be a little audacious than overly conservative. If you get somebody something that says the total addressable market here is $17 million, they're not going to take the meeting. It's not a big enough market. But if they come to find out that you've taken a niche of a niche of a niche of a niche and said, well, I think we can actually get $17 million in the first 3 years, so I made the total addressable market $17 million. That's too conservative, right? And it's not really your total addressable market anyway, but be careful in doing that. But also be forthright. And what I mean by that is investors are going to ask you questions and they're going to challenge you. If you talk around that objection in ways that it makes it seem like that objection is not relevant, or that objection is easily overcome, or it's no big deal, or what are those things go, that's typically when people go, I don't know if they've really thought through these things, or I don't know if they're really being honest with us or themselves about what's in front of them. This is a really big point, and we run into this a lot, which is just because it's not venture fundable doesn't mean it's not a worthwhile business. I have said to people, and I literally am having a meeting probably, I think in 2 weeks, I have it scheduled, where somebody has I think it's a $70 million total addressable market in the US, and it's not big enough. And that sounds crazy, right? Because people will go, well, if I got 10% of it and I had a $7 million a year business, that's pretty good. Agreed. It's not a venture fundable business because, again, as Haley had mentioned in the VC math, that doesn't equate to big enough returns to make it worth the bet. So if anybody is familiar with the term Moneyball in baseball, the whole idea was the Oakland Athletics hired basically a statistician who came in and traded all the home runs and all the RBIs and all the other kind of big, what we would consider vanity metrics, to on base percentage. That's it, getting on base. And as many times as I can get players who can get on base, I can win a lot of baseball games. And it's true, they won a lot of baseball games, and they got pretty far into the playoffs. They ended up losing. But the point is, that's the antithesis of what VC is doing. The antithesis of it. VCs want Sammy Sosa, Mark McGwire trying to hit as many home runs as possible, knowing they're going to strike out a ton and they may have no RBIs. We don't care. As irrational as that sounds, it's not the type of investment. That's not how VC math works. It's all based on the power law and the idea of very few companies are going to offer that return. So every single investment we make, we have to expect that it's going to be the one that carries the entire fund, or we won't invest. And that's hard to hear sometimes as a founder, because it doesn't mean it's not a good business. Making $7 million a year, and let's say you're clearing, $1.8 million in profit back to you as the founding team or as the founder. I'd take that. It's pretty great, but it's not a good fit for VC investors. Weak or undisciplined fundraising efforts will net poor outcomes. If you try to go too fast, if you don't put your whole heart into it, if you don't really do your research, or you're just undisciplined about it, you're going to get poor outcomes. There is no, tooth fairy here. Nobody just shows in and says, wow, you're great. You had to do no effort. Here's a pile of cash with very little expectations. Good luck and, hope you do well. It's just not how it works. And always remember this, running out of money is worse than getting diluted. A lot of times we see founders get really, I don't want to say upset, but they get really nervous about dilution. And I understand that. But at the same time, like it's way worse to not take a deal because you feel like you're getting diluted and then ultimately run out of money or resources or whatever you need to get to the next level. So just keep that in mind. You can be sensible about it. You don't have to give away the farm. That's not what I'm saying, but I'm simply reminding everybody, remember, getting diluted is far less worse than going out of business. And that's it I had for questions.
Perfect. We've got one question related to what you were talking about in terms of the vanity ask, the vanity amount or valuation. Is there a negative consequence of asking too little? Could that be a red flag of investors thinking that, you don't, or you aren't asking for enough, or you won't get to your next milestone?
I think that the risk is that, have you really considered in detail, and do you really know what's in front of you? That's probably the risk. But at the same time, most early stage investors, especially kind of structured capital, we expect that. We know you don't know, right? You're going to put a pro forma in front of us and we joke around and say it's a work of fiction, right? And that if it lasts more than 14 days in business and in practice, it's probably overperformed by 4 days, right? So we understand all of that. But so is there a risk? Probably not. I think the bigger risk is in that big number that's not justifiable, sends probably some signals that aren't as favorable, maybe.
Awesome. And then a couple questions related to type of incorporation. So we've talked some about some investor preferences for Delaware Cs or otherwise C Corp. I know you might have a particular perspective on that, but could you speak some about investors' preferences about where you're incorporated and the type of incorporation, and a specific question about a company that's currently at S Corp? And I imagine there's, it would really vary by the specifics of the business, but if they should consider converting to a C Corp to open up their investment.
So here's my overly simplistic version of this. If you're not doing an equity raise, you don't have to be a C Corp, right? You can be an LLC, you can be an LLC with an S Corp designation. Doesn't really make a huge amount of difference. The reality is when you're doing a debt instrument that is not tied, it's not a purchase of equity, so convertible note, safe agreement, even debt, I guess a debt financing agreement or an AR financing agreement if you got super exotic. Those are all just debt instruments. And so it doesn't really have to be, and we don't require it. If you go to an A round or you go to an equity round, that usually, for all intents and purposes, you have to go to a C Corp or some version of a C Corp. And you will find investors that are doing non-equity purchases that still want you to be C Corp. I don't run into it a ton. It's not a big consideration for us. So.
Great. A couple questions about those businesses that may be a great business, but not necessarily a good fit for VC. So say you have a company, our rough, it really varies, but our rough minimum is is 500 million to $1 billion market size is kind of the minimum we want to see. If you're under that, what are some opportunities for raising capital?
Angel investment and try to bootstrap it from there. You can absolutely find seed stage investors that are non-VC. Family offices. Not every family office is applying the power law. We have a family office here in Birmingham that does a lot of those kinds of deals. They're looking for dividends over time. They're looking for distributions once the company becomes profitable, and they're happy holding those assets or that equity for 20 years if they think it's worthwhile. So it's just not something that usually fits for VC, but there's a whole other slew of investors that could be really excited about doing that. Joint ventures, right? Something like that. All of those things don't fall into that VC power law kind of rigid math.
Awesome. I think that's all the questions we have in the chat. Oh, wait. Someone asked, can you expand on why you're not keen on safes early on?
A couple of things. One is, depending on how the safe is written, no maturity date means it can basically stay out there forever. If someone were to raise a bunch of money and never on a safe note, and let's say a bunch of money, but let's not being arbitrary. So they raise $1 million on a safe note and they hit their stride and they never go out and do any more financing ever again. Well, the investor's paper is worthless because a safe requires that to convert into equity at some point in time. If you never go out and fundraise again, it never converts to equity. And then effectively we own nothing and we get nothing back. So that's a problem. The other problem with a safe note is, in general terms, that it's potentially easier to get a large cooperative or syndicate of investors on a safe note than it is on a convertible note. And the issue there is, again, expanding cap tables. If you have 15 people on your cap table for a $500,000 raise, those are 15 people that you have to convert at some point in time in the future, even if you do convert. So those are two reasons why we do it. In essence, the alignment of motivations between founders and investors are not are not very well aligned on the safe note. And let's remember, the safe note was created very specifically by Y Combinator as a bridge financing tool for people coming out of their very specific cohort. And at a time when Y Combinator companies were getting on a numerical basis, somewhere between 96 and 98% of the companies for the first 3 years went to some sort of price round. So in essence, those safe notes were pretty safe, excuse the term, but somewhere outside of Y Combinator, they're not actually really built for that. And they became a vehicle to make it easy and all of that stuff. But the reality is a convertible note, the legal costs in convertible note are not substantive. I mean, it's a couple $1,000s to do it as opposed to a safe note. And be honest with you, we just did a safe note as a bridge financing for one of it. Our legal fees were about 66% of what they are in a regular convertible note. So the advantages of that are even negligible.
Great. A couple questions relating to your perspective as a VC. So one is, what are the characteristics that you're looking for in a founder? When you meet a founder that you end up funding, what has made them stand out? And two, where can founders find more information about a VC's perspective as they're preparing to raise?
Yeah, that's a great question. Both of those are great questions. The first question, number one, in a way, is adaptability and willingness to learn. The trouble is, if you have a founder who has a very specific view of the world and knows exactly what they want to do, and come hell or high water, that's what they're going to do. And if they're right, great, they'll be wildly successful and everything will work out the way it's supposed to work out. The reality is overwhelmingly that doesn't happen. That there's something that changes. There's a pivot in there. There's a change in the market. There's some unforeseen competition that comes out of nowhere, whatever the case may be. And so usually when we see that, as we're asking questions, and I kind of alluded to this before, which is, if you're talking around a problem, right? Or if you're talking around a question, you're not really answering it, or you're answering a question that wasn't asked, which actually happens a lot of times, believe it or not, which is also very frustrating, by the way. Don't do that. Part of what that's telling me is, are you really going to respond to feedback, learn from it, and apply it in the most effective way? It's not to say that we're right. It's just to say, what behaviors are we seeing? Because whether your investor is right or wrong, or taking feedback from an investor or potential investor, the signal it sends to us is, well, what happens when the customers tell you, or the market tells you, this isn't exactly right, we really need it to be more like this? You're likely to be as rigid and not listening to that feedback as you are any other feedback. So that's a big one that we look for. Previous expertise, right? Anything that speaks to addressing execution risk. Have you done this before? Have you failed before? That might be actually a good thing. What did you learn from that failure? Have you worked at a startup before? What's your background? Do you have a subject matter expertise? How do you pair with your co-founders? So are you the sales and operations co-founder? They're the tech founder? Those kinds of things matter. How does that match up? What are your motivations? Where do you want to be? Are you on a VC track, or are you on a, in 3 years, somebody's going to offer me $25 million, and I'll be really happy because I'm going to net about $12 million, and my VC is going to net about 2x what they put in, and they're going to be very unhappy. All those kinds of things kind of come in as far as those alignment. But again, number one, more than anything, is adaptability, willing to learn, willing to pivot, willing to change based on what the market and your customers are telling you.
And what about where the founder can understand VC perspective?
Yeah, I'm trying to say this the nicest way I can. VCs are completely full of themselves 90% of the time. So we are littering social media with our thoughts on the world, myself included, right? Usually they have very little to do with VC and more to do with like dumb stuff. But we have a footprint, a digital footprint, and a lot of VCs have a really wide and long and laborious footprint. So you can find out a lot about who they are and how and what they think about and all that stuff. You can also see, like, what are they celebrating within their own portfolio? What are they deeming as successful? And then the other thing is, go back to what I said before, which is find the people they funded and talk to them. Founders, for the most part, and this isn't always true, but founders for the most part are really receptive to other founders, even if they're a much earlier stage, at least in my experience. If you're an early stage company, you want to call a post A round funder and you message them through, Twitter or Instagram or whatever, wherever you, LinkedIn, I don't care. And you say to them, you say, listen, I'm a founder, I'm at this stage. I'm actually looking at an investor or thinking about approaching an investor you got funding from. Do you have 5 minutes just to chat on your experiences? I have seen overwhelmingly that to be a positive response, and they'll give you a half an hour, whatever you need.
That is great. VC Twitter is definitely a thing. You should follow some people on there, and yeah, other founders what they experience can share a lot. So a couple questions. I'm just going to rapid fire these couple of things, and then
Sure.
What we have time, you can answer. But one, thoughts on solo founders. Do you see barriers to solo founders raising money, and how would you advise someone to move forward if they are a solo founder? And relationships with investors that you may be too early for, if you're not raising, or they tell you you're too early, how to manage that relationship? Do you stay in touch? How those good things?
Yeah. So first thing, solo founders. Solo founders are fine. Solo without a team, or at least a planned team, that is going to be a struggle, because the reality is you can't do it by yourself. And even if you work all the hours of every day, there's a limit to how big you can get and how fast you can scale. So solo founders are fine. Don't go out there and just find some random co-founder so that your founding page isn't just you, but go and find the people you want to have work there. And it's fine for you to tell them they're not going to work here until post funding, but here they are, here's their backgrounds, they're on board, they're ready to go. So that's what I would say to that one. What was the second one, Haley? I'm sorry.
If you're too early or not yet raising, or someone tells you you're too early, do you maintain that relationship? If so, how so?
Yeah. So half the time that's true, half the time that's not true, right? Half the time that's an easy way to get you off the phone without hurting your feelings. But I would say, based on what you think they can do in the future, and if you liked dealing with them, if you thought they were good, if they were helpful, if they had some insight that you thought was worthwhile that you're actually going to act on, even though they're not doing it, stay in touch with them, send them periodic emails, put them on your monthly updates. Almost every startup that I know has a monthly update that they send out. And as a matter of fact, one of the monthly updates that one of our companies sent out actually got them back into a fundraising conversation they thought was dead. They actually got an update and they're like, oh, we didn't realize it was this, right? That's very compelling. Let's get back on the phone. And they actually ended up doing a multi-million-dollar deal based on a monthly update. So that's one of the ways to do it. So don't underestimate like newsletters, monthly updates, just dropping them a note every once in a while. The other one, and this is my old sales guy talking, is set up a Google alert for their firm or so their companies, right? Something good comes across, email them and say, hey, just saw this about, XYZ Corp. That's pretty cool. Congratulations on the raise. That's it. Not asking for anything, just staying in touch. Those things are effective, and they do remember that stuff. Building relationships for future opportunities is definitely worthwhile.
Awesome. Last question, I think we'll have time for Clubhouse. Have you seen anyone successfully raise on Clubhouse, or make relationships that they're able to convert into investors on Clubhouse, or some of those new emerging communities like that?
So no, but I will also tell you that I have very low opinion of Clubhouse in general as a platform. So that's a little bit of old man yelling at clouds, I guess. But yeah, it's not really my thing, and I don't suspect it's going to work that well. But people raise via Twitter now, so who knows? Maybe that is the next thing.
Great. Well, Matt, thank you so much for your time. This has been very helpful. I see a couple comments in the chat of how informative this has been already. And as you see here, this QR code, this is Matt's link, so you can get his contact info there. I think that is all the questions that we have. So thank you all so much for joining us. I did remember to record this time, so I can get you all the recording after it downloads.
Thanks, everybody. Have a great day.
Thank you.